Over the last 15 years, I've had a chance to look at thousands of businesses and look at their financials, and then learn from the business owner what are they actually looking at to help them make decisions. And what I found is that most small businesses are flying blind. When it comes to their numbers, they check their bank account, maybe their P&L, but they're missing the actual signals that show up in the business to determine whether or not it's healthy. So in this episode, we're gonna break down the 3 most important KPIs that every business owner should be tracking, just numbers that drive growth. If I haven't had a chance to meet you yet, I'm Roman. I'm the founder of Full Send. We help $1 to $10 million businesses turn that financial chaos into clarity. Whether you're running a SaaS company or a services-based firm, these 3 KPIs are going to be the clearest window into whether or not your business is performing, growing, burning, or maybe stuck. KPI number 1, what you need to be looking at on your P&L every single month, if not week, is your gross margin percentage. So this is the number 1 signal of whether or not your core business model works. It tells you how much fuel you can actually have after delivery costs. So if you have a low margin, you're not going to be growing. What you're doing is just recycling dollars back in to generate revenue that doesn't actually drive profitability in the business. This margin signal, this is going to be your top line revenue minus your costs to deliver that revenue. If you're a SaaS business, that might be hosting costs, that might be DevOps, things like that would go into your cost of goods sold to determine your gross margin. If you're a services-based business, labor is going to be your number 1 factor that goes into gross margin percentage. So your total services revenue minus your labor and additional tech costs then drives your gross margin. What you need to be looking at is, are you tracking gross margin to drive dollars back into your operations to continue fueling the business? If you don't have money left over after delivering your service or your product, you don't have enough to reinvest in marketing. You don't have enough to reinvest into improving your operations. You don't have enough to invest in hiring new people. If you don't separate out your cost of goods sold clearly in your profit and loss, that is the first place to look. You need to fix that now. If you're a SaaS company, oftentimes that comes through the form of labor allocations up to cost of goods sold. For many businesses though, that I've seen, they don't actually separate it at all. They just have their revenue and then expenses and then whatever is left over as their net income. So you can start to take costs that are attributed to delivering your service and categorize those cleanly in your cost of goods sold to derive your gross margin percentage. Typical benchmarks by industry, SaaS, we want to see a 70 to 85% gross margin percentage, and for a services-based business, generally like 45 to 65% would be a really healthy target to set as a goal for the business. Now, the second metric to think about is, what is your revenue per full-time equivalent? Revenue per FTE. So this matters because it really shows productivity of your team, not just how busy the team is. As a leader, you get feedback from your team. They say, oh, I'm overwhelmed, oh, I'm busy, but you may not have a way to measure that. Measuring your revenue per FTE helps you measure leverage over time. Are you generating more output per headcount in the business? This is really a key metric for scaling without scaling chaos internally. You want to look at that FTE number, you want to look at your total revenue and divide your revenue by number of FTEs that you have. Now, I will say, if you have a business that does have part-time contractors, the full-time equivalent calculation should be inclusive of contractors. So if you have somebody working 20 hours a week, you can add them into the calculation as 0.5 FTE. That'll give you a little bit more accuracy on the output of your team. Now, typically what we see is that if you're less than 100K per FTE, you're likely overstaffed or possibly you're underpriced. If you're running 150 to 250,000 per FTE, that's usually pretty solid for most services or SaaS-based companies. A lot of SaaS-based companies, you see them push north of 500K, even upwards to $1 million once they reach scale. Tracking this metric over time will help you get a little bit more confident in understanding how your delivery, how your operations are moving forward to help continue to grow the business. The third KPI to think about is your net cash burn, or what you may see in your financials is operating cash flow. So this matters because what often happens is that business owners will look at their profit and loss statement. It may show a profit, but cash flow shows a different story. It's actually showing reality. So this tells you how much cash you're actually burning each month or how much cash you're generating each month. And we all know that cash is the oxygen of your business. You need it to survive. You need it to grow. You need it to move forward. forward. So by tracking your operating cash flow, by tracking your net cash burn, it helps you to understand where cash is going in order to reallocate cash on a monthly basis. What I often recommend is to track this figure on a 3-month rolling basis. This will help smooth some of those lumpy inflows and outflows and give you a really good picture over time as to how your business is performing. Now, most accounting softwares like QuickBooks can help generate a statement of cash flows that will show you what your operating cash flow is if your accounting is up to date and is categorized in a way to allow you to have insights into that side of the business. I would far prefer a business owner to be tracking the cash flow over their net income to help them understand how their business is operating. Tracking revenue is really easy. You look at your P&L, you see what your top line number is, there's your revenue number. But tracking the signal is where the real edge comes into play. Gross margin tells you if your model works. Your revenue per FTE shows you if your team's actually scaling wisely. And then your cash will show you how long the game will actually last. If you can nail these 3 metrics in your business and track them over time and understand how you're trending, you'll start to understand what levers to pull next in the business. Let me know if that's helpful. We do a lot of KPI dashboarding for our clients. You can learn more about how we help visualize this data for our clients at thefullsend.com or send us a note at howdy@thefullsend.com.